Hi, I'm Esther Teo, Senior Director of Fixed Income, and today I'll be sharing with you the opportunities in investing in Asian bonds through the Select Bond Fund. The Select Bond Fund invests into Asian bonds predominantly. The fund is managed actively. It's for investors who want to earn a return that is higher than the fixed deposit rates. And the fund is managed from a ringgit perspective, although it is investing in the regional markets, and the fund may have exposure into different currencies like US dollars, Sing dollars, Australian dollars, but we do employ a lot of hedging strategy to ensure that the fund is not volatile and we are able to achieve our target return that is above the fixed deposit rate. So in terms of how we select our credit, we do have a team of credit analysts that covers global developed markets as well as in Asia. And this group of analysts are the ones going out there to look for ideas, right? The ideas can be generated from primary issuances. So if a company wants to borrow money from the bond market, they will come to the market and we will take a look at the credit fundamentals of these companies. What happens then next is that the credit analyst would do a fundamental analysis looking at the ability of the company to repay us, because when you're investing in a bond, you're literally lending money to these companies, right? So the most important part is to make sure that we get back our capital at the end of the bond maturity. Secondly, we look at valuation, right? So, a company can be of very high quality, but the bond might be issued at a very low yield. So we do need to take into consideration the valuation, whether it makes sense for the risk that we're taking. And thirdly, of course, we need to understand the macro environment and the technical of the market. That means what is the demand for this particular bond versus the supply. In the bond market, I think these three factors, the fundamentals, valuation, and technicals, are the three things that drives bond performance. So we pay a lot of attention to governance because a corporate may have the ability to pay you, but they may not be willing to pay you as well. So we need to make sure that the investment that we have done thorough research. Of course, last year, we had a lot of central banks have cut interest rates tremendously, right, to support growth in the midst of the pandemic. But this year, we do expect that vaccination will take place, economic recovery is taking place, and that's why we are seeing that long-term interest rates is rising, and that poses a challenge to fixed income funds, right? So how we want to position the fund is to make sure that we reduce our portfolio duration, which means we want to reduce our exposure to long-dated bonds and switch to short-dated bonds. That will protect the portfolio from capital losses. And on the other hand, because of the economic recovery, we do expect that credit should perform better than government bonds as well. Also, last year, a lot of companies have raised significant amount of cash war chest to support this time when it's very difficult. So I think this year is a time where credit should outperform, and we are positioning our portfolio more towards the credit market. So bonds, as you know, is a significant part of the asset allocation for a lot of pension funds and insurance companies because it provides that stability. It's a low volatility product, right? So it kind of stabilizes your total portfolio. And one of the other reasons why people like bond funds and investing in fixed income is the income generation. By investing in the bonds, you get a very regular income distribution as well.